welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. At a time when India is battling the second wave of coronavirus, which, apart from everything else, is sure to have an impact on the stock market too, investors are worried, thinking, what if there's another crash like the one last year? Or will this be a temporary breather before the markets march on? What should one do with his investments and SIPs? So there are a lot of questions puzzling investors at this point of time. And to discuss this and much more, joining me today is Dhirendra Kumar, CEO Value Research, and K.S. Rao, Head of Investor Education, Distribution Development at Aditya Birla Sun Life AMC. A warm welcome to both of you.
Thank you.
Mr. Rao, coming to you first. The markets have again turned jittery after a sharp recovery since the announcement of the first lockdown. So what do you think investors should do?
Thanks, Ruchira, for having me here. Thanks to you and Dhiren for being part of this hangout session. Thank you so much, and I pray and wish all the audience they are doing well, and hopefully everyone is fine, and do take care of your health. And coming back to the question, it's like markets are always volatile, whether COVID or not COVID. It is, we can't do much about it. And yes, last year, having seen the, in a year we have seen one up and one down at one go, and things have changed very drastically. People are little apprehensive and they are taking a calculated call on their investments. But of late, when I am talking to the people, looks like they are more matured this time. And I could see in the mutual fund industry side, the number of SIPs, number of new accounts going up, and hardly we could see any redemptions around. I also look one need to look for you. I always say this: personal finance is a person to the person comes before the finance. Then one need to take such a call. What is important for me? And it's not exactly the market fluctuations. And if I'm investing according to my goals, and if I set my clear goals, and if I have right goals in place and my investment plan is on, then I'm perfectly fine to stay with my investments. And I keep advising people, when you are investing, not only have a goal, but you also have your own investment philosophy statement, why you are investing, what you are investing, so that you understand there is kind of a journalization. And with this journal, you know how your fluctuations, markets are fluctuating, but you should not get fluctuated with your investment decisions. And that's where you need to stick to your goals. And if there is a thing, rebalancing the asset allocation, it can be a right to do. And the last but not the least, it's have a discipline to invest in any time of the market. And once you have a right asset allocation, I think you are on go. And don't worry too much about the market, how it will. And none of us can predict the market. We need to prepare for the worst, and we need to be there.
All right, now Dhirendra, coming to you. We've often heard you advise investors not to sway from the basics and focus on what's in one's control. So do they need to do anything different this time round? How should the investors go about their investments now that the fresh round of lockdowns and their economic impact weighs on their minds?
No, I don't think investors need to do anything differently. If one is onto a methodical investment plan, and if it is very much in line with, if it is aligned with your goals, which could be, for the short run, for the medium term, and if you have your emergency fund in place, then you don't need to do anything different. Of course, the different thing, the difficult thing which one needs to do is keep away from noise. Because what is happening is that because our surrounding is very difficult, and you see people in your surrounding facing the kind of difficulty which is very difficult to reconcile with or imagine that one could be. It looks like the world is coming. Many a times it will cross your mind that the world is coming to an end, and it will not. And that is something which, staying the course with your plan. And that requires that you have your foundations very, very nicely in place, which is having an investment plan, your investment plan very much aligned to your goals, which should translate into an emergency fund as well as the asset allocation, and build a temperament right now to stave off the noise. Because every day now we will be getting different kind of signal, and they are not signal. I would say that if 5 years from now the world will be a better place, if 10 years from now world will be a better place, then you don't need to do anything for your long-term investments.
Virendra, last year when the markets fell, thousands of investors opened trading accounts to start investing. On hindsight, they may even have benefited from the subsequent rally. So, do you think this is an opportune time again to make some opportunistic bets?
I really wonder that the people who have benefited from the people who would have tried their hand in the stock market, and the new kind of vehicles that are enabling them to trade effortlessly, uh, they will be willing to listen to us. But I will still have my suggestion for them that they should stick to a plan. They should make a plan at this point. And if at all they need to, uh, right now, anybody who has benefited without much of a thinking, simply because one was courageous or brave enough to invest last year after May, and he would have benefited, then I would just like to point them that one may not be lucky, and it is not that easy to make money in a sustainable way all the time. Devise your plan, and for those people who have benefited, I will have a small suggestion that have your long-term plan, have your emergency fund, and have your fund allocation. Make sure that you have your 1 lakh rupee, 2 lakh rupee, 5 lakh rupee, or 2% of your money, 5% of your money invested in stock market while you're enjoying it, because you are working from home, you have the time, you also get engaged in the market, and you're benefiting. The reason why I'm suggesting that have your boundary for the fund allocation, for the trading allocation, is simply because if you don't do that, and if you 80% of your money is here, and simply because the market was going up and you're benefiting, you will be in for a nasty surprise. And when you create this boundary with an understanding, if the market turns around and turns around for the worse, you'll run for cover. And at the same time, I would say that the leverage trade which has been enabled by these trading vehicles, uh, they're very dangerous. They could turn out to be a very risky vehicle, because you invest a lakh of rupees and you are able to do trading worth a lakh of rupees, 10 lakh rupees. It is this kind of leverage. So what happens is, when your 10 lakh rupee becomes 11 lakh, it looks like 100% return on your 1 lakh rupee investment. But one is missing the point that if your 10 lakh rupee investment on account of leveraging 1 lakh rupee, if it becomes 9 lakh rupee, then you lose 100%, and that could be devastating. So I would say that understand what you are getting into. If at all you are having fun, or you're enjoying it, and you're developing an understanding, or you're learning, have your boundaries very clear, and don't put all your financial worth to this mechanism, and to keep away from, so that something happens here, your overall plan doesn't get disrupted.
Also, Mr. Rao, an emergency corpus is perhaps the most important buffer to have these days. I'm sure you agree to that. So, how should one go about it? Can you please tell our viewers?
Yeah, Richard, I think last 1 year is definitely an example for us. All of us need to have that emergency fund. It is there could be like many of the people have faced the job loss or salary cuts, and this is a pandemic has thrown out of the balance for everyone. And earlier, I used to suggest people like you should have 3 to 6 months of the emergency fund. Probably now can it be a 6 to 9 months of the emergency fund? And emergency fund is a must to protect your other portfolio. By having an emergency fund, it's not exactly the returns you are getting on emergency fund, but this fund is protecting you the returns and staying invested and getting the benefit of power of compounding for other investments you have. And invariably, all of us need to choose our emergency fund rightly and appropriately, and one need to put basic mathematics into the calculations in place for the emergency fund. I can sit back at home and see what are my expenses, major expenses in a month, and what are my insurance premiums I am paying. All that put together, if I have 8 to 9 months or 9 to 12 months of emergency fund separately available, then I am done with emergency fund available. If somebody is started and having an emergency fund, it's fantastic. If somebody has not started, it is a time to look how you can create your emergency fund. Even you can even invest in the liquid funds through SIP route every month to create an emergency fund that can become for you. And this emergency fund, I suggest you can have a separate account where you do not have an access to it too often, and whenever it is needed. Emergency is truly meant for emergency. And in fact, we call earlier, predominantly we used to tell it is a contingency, but now we have many emergencies coming in. And when you are and recouping the emergency fund is also equally important. Probably part of the money I would have used it. Can I get back and pull it out and keep that emergency fund? Maybe if I'm thinking 9 months is crucial. For some of us, it could be 9 months, or some of us, it could be 12 months. As I said earlier, it's personal finance is changes for the person to person. Once you decide, keep that emergency fund. You have an option to put it in the liquid funds. You have an option to put it in the savings bank account, or you want to put it in fixed deposits. Choice you can use you have multi choices, but having an emergency fund is a must. That will help you to build your other corpus working for you, so that you are not detrimental to yourself to redeem your money when you are not having emergency fund.
Also, Mr. Rao, how important do you think is the role of asset allocation in one's investments?
Oh, absolutely. Asset allocation is the foremost and the most important, because once you have a right asset allocation at this point of time, I don't look at how the market behaves. For example, in the last 1 decade, if I take various asset classes, if I take one asset class, last year everyone was pouring the money was the gold, and in the last 10 years the fluctuation, and the gold was not given much returns, but last 1 year it has gone up, and at that time you see there is a huge money which is coming into the gold as an asset class, and today the gold has underperformed a little over maybe 12 to 14% on the negative side. And any asset class can underperform, any asset class can overperform. Are you balanced, and what kind of asset allocation you are looking at? And today at mutual funds, there is one great thing has happened. There is a way you have an asset allocation funds, and you also have an auto asset allocation under balanced advantage funds. Each fund manager got different way, but you look at what is the asset allocation predominantly you are looking at. If I want 50-50 equity, or if I want to have a 3 assets into different one, or I would like to have a multi assets, whether I want to manage on my own with expertise, or if I want fund manager to do on. If you want to give it to the fund manager, probably come back to the multi-asset class funds or balanced advantage funds. You have an asset allocation fund, but asset allocation is the most important one at this point of time, because you don't need to worry how which asset is doing well, because each assets will perform differently at a given period of time, and it's the most important one.
So, Dhirendra, how should one go about figuring out an appropriate asset allocation, and what are the suitable funds for the different asset allocations?
I would say that there isn't a thumb rule. There isn't a science which says that okay, this person, because he's young, he should have this asset allocation. Those kind of generalizations don't work here. Two things which should govern your asset allocation, or which should govern anybody's asset allocation, which is how much time you have for your investment. So if it is more than 5 years, 7 years, 10 years, you can actually think differently. And the other is that what is your experience? Because even if you have 15 years, 20 years, 25 years for your investments, and you don't need that money for this time frame, you can't really get very aggressive, simply because if you don't have any experience, and if you are faced with a situation like March 2020, you will run for cover, and you will run for cover at the most inopportune time. So I would like to devise a broad rule framework for people to follow, is that you need to choose, depending on the time frame, one of the 3 asset allocation, which is a third of your money, half of your money, or 2/3 of your money in equity. So this you have to choose one of these 3 slots, and that will actually make it uh, meaningfully clear in sense of achieving your goal of having an investment allocation which will get you the desired stability. So because asset allocation is not to maximize your return, asset allocation is to give you a kind of experience which will not scare you to get out of your long-term investments. So this is one. Choose one of the 3 things, and if you are less experienced, if you are investing for the first time, then first 3 years be in the first category, or be at most be in the second category, which is 50% equity, 50% debt. If you do that, you will not be forced, or you will not be scared, or you will not be driven to get out of the market at the inopportune time. And how one should, and the most important part of asset allocation is to be able to keep an eye on that and be able to rebalance. If you do your asset allocation that I'll be 50% in equity, 50% in debt, But when you're 50% in equity becomes 70% of your portfolio because of appreciation, and you do nothing about it, then this asset allocation will actually not be useful. Likewise, if your equity goes down in value and if you're unable to change that allocation or reset that allocation, you will not benefit from this asset allocation that you have decided for yourselves. And so allocate your asset, keep it simple. Your experience should be the primary guidance besides your investment time frame, and rebalance, and don't be tempted to rebalance every now and then. Give it a year's time, and or if your asset allocation changes by something like 10% or 15%, frame your rule, follow it for rebalancing an asset allocation.
All right, time now to move on to the viewers' questions. The first one comes in from Amit Kanthal, who wants to know if it's a good time to redeem investments from a pharma mutual fund, or should he hold?
My suggestion will be that if it is just 10% of your total investment, hold on. If it has become more, then pair your position. Simply, or if it was an opportunistic thing and you just landed because you thought that, and it has worked out nicely, it has appreciated, then take your money out, because pharma fund is good to have. More so, it would have been beneficial, but it may not be desirable, because if you have an otherwise well diversified portfolio, that will also have meaningful allocation to pharma, maybe 10-15%. Look at your other investments, and one has to decide accordingly. If you have your other investments and they are well diversified, you should have small allocation to pharma, if at all. And most investors can do without having a sectoral fund in their portfolio.
Now, Mr. Rao, 72-year-old Harinder Pal Singh falls in the highest tax bracket. Some of his fixed deposits are maturing in the near future, and he wants to invest them in debt funds for saving tax. So which category would you suggest? He says he has sufficient investment in equity as well.
Mr. Singh, need to look at debt funds in the mutual funds, especially if you are looking for the 3 years time frame. You get into the tax benefit, not exactly the tax benefit. You have a capital gains, a long-term capital gains advantage, and where you have an advantage over bank FDs. Probably this is the time you can look at some of those low duration fund or corporate bond funds to invest in the mutual funds, or you can look at the time duration. If you are investing for the 3 years, any of those funds matching with your 3 years duration, that would be fair enough. Another one is you can look at your fixed maturity plans, which are fund houses are coming time to time, and most of the fixed maturity plans are for the 3 years period, where you have a long-term capital gains advantage there. You can invest there.
Now, Dhirendra, Akhil Raj says, you usually suggest spreading the investment over 2 to 3 years if one has a big lump sum to invest. So he wants to know what should be the strategy if someone comes across a big downside in the market, say a 10 or 20% correction.
Yeah, I normally say that, spread your investments over time in a manner that, and there isn't a thumb rule here once again. It normally keeps your, anxiety in check. And because the moment you invest a large sum of money in the market and you're faced with a big decline, it's a big dampener, and it drives you, it scares you, and many a times, if you are not an experienced investor, then it can drive you out of the market. So that's the primary reason. What to do, how to benefit from the big decline? That is why you should have an asset allocation. Assuming that as an investor, you have chosen to have an asset allocation of 50% into debt and 60% into equity. And if there's a 10 to 20% decline in the market, your equity will immediately decline in value. And that is the time when you should move your money from fixed income to equity, and that is how you will benefit a little bit. And that is how to benefit from that. Maybe if you're at that is the time when you can if you want to adulterate your asset allocation formula a little bit, and you think that you can carry on with that, maybe make your equity at 55% instead of 50%. Don't go in a very knee-jerk way. And so sticking to asset allocation, calibrating it a little bit, can drive you, can actually help you benefit from the big declines that come in the market most of the time.
Mr. Rao, Indraneel Haldar asks, if it's mandatory to redeem the mutual fund or stock investments for a year after the death of the investor, what procedure should one follow during his lifetime to ensure a smooth transmission after his demise? He wants to know.
Yeah, Mr. Indranil, you doesn't need to redeem. I mean, it all depends on the how the nomination is being done or how the investment is done. If it is the nominee, I mean, there is a we can from the nominee you can get the succession right, and we can reissue the units. We can transmission of units are possible. Or if the first applicant or second applicant is died, automatically it's a first applicant predominantly. It will go to the second applicant. But if there is no nomination registered and it's not second applicant, then we need to follow this process laid down by the regulatory system. I mean, you need to go for your succession planning, or you need to have your succession certificate, and you need to come back to the mutual funds or the stock market, NSE or BSE, to get your amount right. Probably, but not all the cases we need to redeem and reinvest again.
Dhirendra Kashish Singh asks, in the current scenario, what should one consider as a good return on the investment with a span of 4 to 5 years?
4 to 5 years time frame, it depends on the investment vehicle or the asset allocation which you are choosing. If it is a equity heavy portfolio, then I would say that it should beat the fixed income. Say, 2/3 of your money into equity and remaining in fixed income. Given that inflation has come down, interest rates have come down, so one has to lower one's expectation. I would say that 1.5 times more than what the prevailing fixed income return is, or the risk-free return is, or what you get on a term deposit, is the kind of return which I would expect from a equity heavy portfolio. If it is a balanced portfolio, then little less. And if it is dominantly a fixed income portfolio, then substantially less. And there I would say that through a mutual fund vehicle, a 10 to 15% premium to the deposit rate for that corresponding period. So if the 4 to 5 year deposit rate from a bank, which is nearly risk-free, if not completely risk-free, then if it is 6%, then 7 to 7.5% will be from an all fixed income portfolio. So calibrate your expectation. And why I'm saying that these one should realign one's expectation from the market or the returns is because inflation has come down, and that is why the interest rates have come down. And that is why what used to be, when interest rates used to be 9-10%, and equity used to generate 18-19%, that was good enough. That was still 80-90% premium to the risk or the fixed income return. If the fixed income itself has come down to 6%, and that you earn, assuming you get twice as much, that will still be 12%. So I would say that 4 to 5 years return, moderate risk, 10% return would be a very good return.
The next question has been sent in by Ali Asghar Khambati, who says that his father's fixed deposit has matured and he's now looking forward to investing in an equity fund, but currently waiting for an opportune time in terms of market correction. He wants to know your view on it, Dhirendra.
Mr. Khambati, my suggestion won't help you, because I really can't help you guess the market. My only suggestion will be that if you keep waiting for the market to correct to make your investment, you just might end up waiting forever, because markets for a prolonged period of time, they don't have a logic. Many a time they do the broad direction is very difficult to guess. So my suggestion will be that evolve a plan. Make sure that if you start investing your money over the next 3 years on a monthly basis, and if at all sometime in between there is a huge correction, then maybe accelerate that plan. Make that one-time investment sometime in between. But the advantage of this plan will be that you will not be completely out of the market if market steadily goes up and never corrects.
Okay, Mr. Rao Anand asks, does it make sense for a retiree seeking regular income to set up an SWP partly in a balanced advantage fund and partly in a debt fund? Or should one choose only a balanced advantage fund?
Yeah, I think Anand, the question here, I can deal it in two different ways. The first is, as a retiree, if you need a regular income probably entire retirement money can be bucketed into three different buckets. The one bucket where you need your regular income, other bucket can give there is a growth, or the third bucket can give some safety when you need some extra money to redeem. And here in this case, if you are looking at SWP as one source, definitely as a regular income you can look at in the balanced advantage fund. But part of the money can go to the liquid fund in the initial days to get the things right, so that you will not get there should not be any gap in between getting your monthly payouts, and this SWP can start working from a year 2 onwards. And you can also look at the safe withdrawal rate rather than systematic withdrawal plan at a rate which is more than more than the fund is generating it. You can come to the balanced advantage fund, or combination of the balanced advantage and debt fund can be a good one to look at, but put it into three different buckets. That's a way where you can look at: one as a regular income, other is to get your capital growth, and other where you can take care of your emergency needs. That way it can work out well.
All right, Dhirendra, 53-year-old Ashish Pandey is a retiree and has accumulated some money through SIPs and by selling his house a few years back. He has another house, but he's been waiting for the possession for at least 7 years, 8 years now, but still no luck with it. 90% of his money is invested in mutual fund schemes across 40 plus schemes. So he wants your suggestions to generate a regular monthly income.
I would say that he needs to do a careful planning based on what Mr. Rao was saying about a retiree's allocation to different investments. The amount, first he should go about estimating what is his monthly pension requirement or income requirement to support his day-to-day needs. And that is the first goal. And for that money should be getting into very conservative vehicle, either guaranteed return generating schemes or debt funds to begin with. So something which will provide him income with in a very predictable way. Then he needs to allocate a certain amount to make sure that the capital which is invested in fixed income, it is not losing its purchasing power or it's not losing its value. So that should be his growth investment. And then the third one should be towards his emergency or supplementary income requirement in between. And cleaning up his portfolio of 40 equity mutual fund and is very important. So first he should do this exercise, hold his 3-4 equity investment for the growth portfolio, consolidate his investment in growth portfolio to the extent needed, and move as much money to fixed income fund or the guaranteed return saving schemes like the post office MIP or senior citizen saving scheme. But he's 53 and he may not be eligible to invest in the senior citizen saving scheme right now. So his options will be post office MIP and debt funds. So he should invest there for generating his regular income. And that's about it. Cleaning up his portfolio, because a lot of people got this message that SIP is a good thing, but too many SIP in too many fund may not be a good thing. And so consolidate your investment in line with your goals, and keep your house, the home which you will get if you are currently paying a rent. And once you get the possession of your house, which looks uncertain, then that will require altering your plan, because your outflow for the rental outflow will stop, and that is the additional money which you can allocate to the growth. Your income requirement will get reduced to that extent, and then you can allocate a certain amount of money to your growth capital at that time.
Shashwat has sent in the next query, and Mr. Rao, he asks, is it fine to invest the emergency corpus in a floating rate fund?
Mr. Shashwat, it's a good question. It's like, first, glad that you are parking your emergency fund somewhere. And floating rate fund, part of the money can go to the floating rate fund, probably may not everything, because sometimes in the floating rate fund you have it's like immediate, there is a lock-in for 7 days for some of the floating rate funds, and if you need the money immediately to redeem and get it immediately on the day one, and it's part of the money can go always to the liquid fund, and some of those liquid funds today you can redeem on that day one itself, like As of now, as I need to take my money up to 50,000, I can redeem from the liquid fund instantly. It can get to my ATM. Yeah, it can get to credit to my account, and I can withdraw from the ATM. And definitely you can look for floating rate fund, part of the options, but liquid fund could be a most better option for parking your money.
All right, Dhirendra, today's last question has been sent in by Jhumki, and she wants to know, considering market ups and downs, which category of fund among flexi cap and aggressive hybrids would you suggest to set up an SWP with a 3% withdrawal rule?
I would say that, aggressive hybrid fund can also be good, but 3% is a very conservative withdrawal rate. I don't visualize a situation where you run the risk of consuming your capital, but still having a fixed income allocation in any long-term investment allocation is good. And aggressive hybrid funds are almost an equity fund, because earlier they used to be a third in equity. Now they are tending to be nearly earlier they used to be nearly a third in fixed income, which, because the minimum in equity was 65%. Now many aggressive hybrid funds are going with an allocation of 75% to equity. So my suggestion will be, though 3% is conservative, one doesn't run the risk of consuming one capital even with a big drawdown in between. But I would still suggest an aggressive hybrid fund.
Well, with that, it's a wrap on this episode. Thank you, both of you.
Thank you.
Thank you so much. Thanks a lot.
Thank you to our viewers. Do keep sending us your questions and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel and stay indoors as much as you can. Stay safe. Bye for now.